Hello, I'm Raj from EPK Capital. Over the last 20 years of managing wealth, I've seen markets go through cycles that many thought would never end, only to watch them shift overnight. Today, in May of 2026, we find ourselves at one of those massive crossroads. If you've been feeling a bit of fatigue with your portfolio lately, you aren't alone. For nearly a decade, specifically starting in the 2010s, we lived in a world of what I call easy money. Interest rates were low, tech stocks were flying, and it felt like you could throw a dart at a board of software companies and double your money. But as we sit here today, those old strategies are stalling. The question on every serious investor's mind is no longer about which tech stock to buy next, but rather which philosophy will protect and grow their capital over the next decade. This brings us to the ultimate debate: growth versus value investing. Understanding the difference between these two isn't just academic anymore. It is the most important decision you will make for your financial legacy in this new economic era. When we talk about growth and value, it's easy to get lost in the spreadsheets, but let's look at it through a lens we all understand. Real estate? Imagine you are looking at two different properties. Growth investing is like buying a high end luxury apartment that hasn't even been built yet. You are buying a dream of tomorrow. You're paying a premium price today because you believe that in 5 years, the neighborhood will be the next big thing. You're betting on potential. It's a bet on the future success of a dream. Value investing, on the other hand, is like finding a solid, well maintained bungalow in a prime established area that is currently priced lower than it should be because the owner is in a hurry or the market is temporarily distracted by newer, shinier buildings. You are buying today's reality at a discount. In the growth world, you're looking for the next big winner. In the value world, you're looking for a bargain that the rest of the market has overlooked. At EPK Capital, we've always believed that while dreams are exciting, bargains are what actually build wealth for generations. We have reached a massive turning point here in 2026. For years, growth at any cost was the winning formula. But year to date, we are seeing a dramatic shift. Value stocks are finally outperforming growth by nearly 11%. This isn't a random fluke. The reason is simple: money isn't free anymore. We've entered a period where interest rates are staying higher for longer. When interest rates are high, the dream of tomorrow becomes much more expensive to fund. Investors are no longer willing to wait 10 years for a company to become profitable. They want to see cash flow, dividends, and real assets today. This shift is causing prices to return to their true value. If your portfolio is still stuck in the 2021 mindset of chasing high-flying tech dreams, you might be missing out on the massive rotation towards stable, cash-generating businesses that are currently leading the market. Now, as a bonus, I have created an in-depth guide to the 7 costly tax traps for high net worth NRIs, a strategic report on avoidance and compliance. You can download it simply by clicking on the link in the description. Now, let's talk about our home market, India. We are all excited about India's clear path to becoming a $7 trillion economy. It is, by definition, a growth nation. However, as an expert who has spent 2 decades navigating these waters, I have to give you a word of caution. Because of all this excitement, many Indian stocks are currently trading at very high valuations, with an average price to earnings ratio of around 21. This brings us to a dangerous place called the valuation trap. This happens when you buy a truly great company, but you pay such a high price for it that even if the company does well, your investment returns are poor. You can't just buy India blindly anymore. You have to look for the pockets of value within this growth story. In 2026, the winners won't just be the companies that grow the fastest, but the ones that grow while maintaining sensible prices. We also need to look at how the artificial intelligence revolution is evolving. Back in 2023 and 2024, AI was all about software and growth stories. Everyone was looking for the next app or the next coding platform. But here in 2026, the boom has changed. Today, the real money is being made in what we call the hard stuff: power grids, specialized cables, massive data centers, and heavy infrastructure. These are the industries that actually allow AI to function. Interestingly, These companies often sit in what people used to call the old economy or value sectors. They aren't flashy software startups, they are industrial giants that have been around for decades. This is a perfect example of how value sectors can suddenly become the new engine for growth. It's not about software anymore, it's about steel and electricity. Beyond the numbers, there is a psychological element to this that we must address. Growth investing is inherently exciting. It feels good to tell your friends at dinner that you own the latest AI breakthrough or a company that is disrupting the world. It feeds the ego. But value investing? Value is often quiet. It can even be boring. However, in my 20 years of experience, I've seen that chasing multi-baggers based on excitement often leads to 100% losses when the hype fades. Value investing provides what we call a margin of safety. It's the financial equivalent of wearing a seatbelt. When global markets get volatile, which they inevitably do, having a portfolio rooted in real value ensures you aren't wiped out. Ego wants the fastest car. Wisdom wants the car that will actually get you and your family to your destination safely. Generational wealth isn't built by hitting one home run. It's built by staying in the game and never having to start back at zero. So, what is the right style for the next decade? The answer isn't about picking one or the other. The next decade belongs to a strategy we call CARP, which stands for Growth at a Reasonable Price. At EPK Capital, we use what's known as a barbell approach. On one side, we hold rock-solid, old economy value names that provide stability and consistent cash flow. On the other side, we hold disciplined growth companies that have proven they can survive in a high interest rate world. This isn't about being a spectator to the India story, it's about being a disciplined participant. We look for companies that have the vision of a growth stock, but the balance sheet of a value stock. This hybrid blueprint is how you navigate the complexities of 2026 and beyond. It's how you ensure that the wealth you are building today doesn't just last for this market cycle, but for the generations that follow. Don't just chase the next trend. Build something that lasts. If you're wondering how to rebalance your portfolio for the next decade of Indian growth, let's have a conversation at EPK Capital. We don't just manage money, we build wealth for generations. Visit our website to see how we can align your legacy with the new market reality.